I am someone who has spent multiple nights up until 5 a.m. trawling every source I can possibly get for these stocks. And I just dump them all in an equal weighted index. No fancy Goldman Sachs style stuff going on here.
That's Will Waters, today's guest on Spatial Stack. He's not a Wall Street insider. He's a geospatial professional who decided to understand how our industry actually works as a business and ended up building something no one else had. A Geospatial Index tracking hundreds of public companies, sharing maps, data, satellites, sensors, and software.
The stock market is the easiest way for us to begin to have a productive experience around being an owner of the company.
We'll explore how he built the index from scratch, what it reveals about where geospatial is headed, and how understanding the business side, not just the technology, can open new perspectives for your career and the industry's future.
And if an outcome is that your income from investing matches your income from working, I hope that is memorable to you.
This isn't financial advice. It's a wake-up call about the business of geospatial and why understanding it matters more than ever. The future is spatial, so let's get into it. A note about this episode, nothing in this podcast is investment advice. We're sharing personal research and opinions for educational and informational and entertainment purposes only. We are not registered investment advisors or financial professionals. Always do your own research and consult a qualified advisor before making any investment decisions. All right, Will, welcome. Yeah, thanks for hopping on. And we're going to get into probably a little bit of a different topic than talking about, your regular geospatial technology and stuff like that. But let's get into it. Kind of tell me a little bit about, kind of your journey, and then how you ended up kind of understanding how geospatial companies perform in the market.
It's a huge privilege, Matt, to be on the Spatial Stack podcast. Yeah, you're right up there in terms of the light on the hill, as it were. So yeah, I'm bringing my best in terms of a broader perspective on how we can derive an economic gain, really, and be economic participants in our geospatial industry. So there were a couple of prompts for me to begin this journey, which began around about August 2022. So the first prompt was 2019. I did a short course on value investing. Maybe a better term actually is valuation investing. It's a fundamentals bottom-up way of judging whether or not it's worth buying shares in a business. It was a really useful short course, 3 months. It was only $750 through Stanford Continuing Studies. The professor was Kenneth Jeffrey Marshall. He also lectures at the Stockholm School of Economics. He's got a Harvard MBA. He's a diligent individual who has synthesized decades, really, of academic work about what works in having a productive encounter with the stock market. So that was one prompt back in 2019. I was a diligent student. I promptly got to work applying the framework that we were taught on more than 100 companies. Like anyone in our industry, the first sort of reflex was to make an elaborate spreadsheet that connected everything up and eventually pushed out in an automated way a report in a nice, sort of 10 to 15 page Google document. So I had this framework in my head, and eventually I realized, well, hang on, I'm working in geospatial. There's a few hot stocks. There's a bit of hype around some of the verticals. LiDAR stocks, for example, database stocks. They've been around for decades. Why don't I sort of begin to look at applying this framework, or at least doing the most basic thing when it comes to finance and the markets, which is to make an index. Which is basically just every single stock and some sort of way of assembling them all together and getting an impression of growth across the whole market or industry that the index is tracking. So that's the approach I decided to take. Another prompt was that at the time I was in London in the UK. And, I've had this career from Australia to a couple of countries in the Middle East. I also spent some time volunteering in Cambodia, which is to say that the incomes in the UK are dramatically lower than they are in those other countries where I worked. And they're also significantly lower than in the US. So there was this feeling that I wasn't getting what I knew I could get from my salary in the UK. Plus, I had this knowledge about how the markets worked and some sort of a framework, especially when taking a very long-term position in a stock, to get ahead of what most people get out of the markets. I got to work, and it was in August 2022. I thought I was done after about a month, and I had like 30 to 40 stocks. Most of them were these, new space or Earth observations stocks, black sky, outer space, those sorts of things. And I was like, okay, cool. I've got these 30 stocks. Thought after this, month of effort, we were done. We had this index. But, I have a bit of an obsessive nature. So I kept going. I kept trawling, the markets, there are all sorts of interesting efforts that people have made to track just geospatial businesses in general. And from those listings, some of them were hundreds. Like I even got a trial license for Crunchbase. That was what really turbocharged my efforts. I think I got more than 100 stocks out of that. A Geospatial World is a consultancy in India. They have a market map, and that was really the latest effort, because from Geo Week in Denver, I got their market map, which is a massive, poster. It took 3 hours just to trawl through all of that. So basically my effort was to ignore anything you couldn't buy shares in. And that's key, because us as regular workers with not a huge amount of money, not being so-called accredited investors, so maybe with, thousands of dollars to invest, the stock market is the only way, or the easiest way for us to begin to have a productive experience around being an owner of the companies that employ us. So yeah, that's my initial spiel, Matt.
Yeah. So there's a few things I want to dive into there. One is, kind of unpacking the concept of an index and things like that. I think, also going into this, your background is in geography, GIS, geospatial, and then you later on added in some of this financial investing, things like that. Kind of what drove that kind of, or I guess, first of all, why'd you get into geo? I think that's a good question. And what later on drove you this kind of interest in new investing? I have some ideas why. And as we talked about before, I think I kind of know, but I think, for everyone here, what kind of drove that progression?
Okay, so it's a complicated story. I'm from Australia, as some of you might recognize. I haven't been there. Since 2011, I've only spent 2 years in Australia. I hope I still have some of my accent left. So in Australia, I guess possibly similar, especially for a North American audience, some ways the economy might has some it's in some way reflected in that of Canada's. There's a strong natural resource extraction theme. So back in 2001, when I was in year 12 at school, and the Australian government was sending out all of its various leaflets to try and encourage students to study things at university, which would be helpful for the long-term future of the Australian economy. One of the brochures or leaflets that was sort of letter bombed out across, the nation's high schools was one encouraging people to get into GIS. And my mathematics teacher, his first name was Dennis, I forget what his second name was, he sort of put it in front of me and said, hey, I think this might, be a match for what you're interested in. And I was fascinated, it seemed like kind of I'd never heard of it before, but, it had sort of a techie feel, and, it's cool to make maps, and that was enough to get me interested. At the same time, though, I was an extremely diligent student, and I got a decent, I confess that I was temporarily distracted by doing a psychology degree, only because there was the prospect of, great incomes and all of that. But I was in no way emotionally cut out for a career in clinical psychology. So funnily enough, I went back sort of full circle and ended up doing eventually a master's in GIS at the University of Melbourne. Yeah, that was, I guess, how I got into it. And what grabbed me initially in, the first sort of years of applications of this was actually when I got a volunteering position with Engineers Without Borders Australia in Cambodia. And we were applying geospatial in the service of, or to advocate on behalf of people who were being evicted unfairly from urban poor communities, which is the politically correct term for slums, in the capital of Cambodia, Phnom Penh. And we deployed the Ushahidi platform, which is a simple open source, both desktop and mobile kind of app for getting volunteer geographic information for people, for example, in these urban poor communities, but also having, formal data sets that the NGO that I was working for can provide via the map. Anyway, so what I appreciated in these initial sort of applications of seeing how people were using geospatial in the world was that it was something that could be used for advocacy purposes to help the little guy, if you like. And there was what can I say, in the direction of a spycraft or a surveillance aspect to it. I have what can I say, in some respects, a nature that, well, everybody likes the intrigue. So, I like that aspect of it. So, yeah, about the finance theme. Well, if you want to go really far back, in Wales in the 80s, my father's side of the family were part owners of a bank, funnily enough. So maybe there's some sort of strange ancestral urge to do with finance for me. Another thing was, honestly, I was just, fascinated with the whole finance industry in London, which is where this sort of began. And I wanted to be some sort of a participant in that, maybe begin to build out a network in the finance community in London, which is what I began to do before I came to the US. If that helps.
Yeah, no, that's perfect. Yeah. So on a complete side note, so you worked on the Ushahidi platform. Is that what I heard?
We deployed it. This was back in 2011, 2012. Aware that it's, as far as I'm aware, it sort of began in a community in Kenya. I could be wrong, or at least that was an initial high profile.
Yeah, I remember that from many years ago. It was just a random, I think one of my first blogs long time ago. I don't even know if it's still out there, but it was about that. So that's a funny tangent. So yeah, I think, looking at all of that, and I think kind of unpacking, all of the different financial aspects of this, which is, one of the big things I think I want to dive into. First of all, let's kind of lay out some terms and kind of for someone who's coming to this completely brand new, how would you define an index? How does one get involved in an index? And what would this kind of look like in the life of just, kind of any person involved? Because I think in many ways, in many modern economies, in some way, shape, or form, we're impacted by the market. The stock market, things like that. Even if you're in the public sector, when there's pensions, in the private sector, investments and things like that. So let's take it step by step, kind of from the basic building blocks, stock and index, and then a geospatial index. What are those things kind of like?
Yeah. Okay. I'm going to start with something else about how credible it is or is not, to be perfectly blunt and honest with everyone, what I'm sharing. So I have prepared some slides, and not to take over about that, but just to get to this important slide. Everything I'm saying, as I've laid out, is based on my efforts as an amateur with, yes, a master's in geospatial, but not any kind of a FINRA qualification or I'm not a chartered, financial analyst, anything like that. What I've tried to sum it up here as being, on this slide, there's so much in the financial influencer space on YouTube about, look at my Lamborghini, and therefore I am credible. So I'm, deliberately going in the opposite direction here. I don't even own a car. I own that little blue bike, right? It costs $2,000. I haven't spent, $50,000 on a fancy new, even just that pickup truck there. Without wanting to put too fine of a point on it, one might say, using financial influencer on YouTube speak, I know 25 times less than this, truck owner. So, just wanted to, I confess I am hamming it up a bit, but just to drive the point home, I am someone who has spent multiple nights up until 5 a.m. trawling every source I can possibly get for these stocks, anywhere from literally surveying companies in Vietnam and Thailand. There's a few stocks from Abu Dhabi, Finland, the UK, the US. So yeah, just to say that this is a starting point, and a great next step might be to actually engage the services of a qualified CFA or someone with some sort of FINRA qualification. So a stock, so you can go and buy, the pizza shop down the street. It's probably $200,000 or something. You would own the whole thing. You would essentially get, what they might say is a dividend from it, or you'd get the income that's left after you pay for the price of the pizza bases, rental of the store, all of the cost of goods sold, and other operating costs, like, in the US, what is it, an hour that you pay for people here, because there's no minimum wage. So part of my vague jabs at the US economy. The thing is, though, that's actually quite a lot of money even to buy that small pizza shop. So what you can do is buy a share. You can break up, the total value of that company down into, I don't know, 200,000 shares. So it's $1 per share. In a similar way, and then you can introduce this thing called a stock exchange, where, maybe I don't want any more of the pizza shop down the street. So I can use what's called a stock exchange to say to other people who are at that stock exchange or on the website for it, look, I have my 5 shares of this pizza shop. I'm selling for the bargain price of 50 cents a share. Would you like to buy them? So, these are the basics, probably painfully basic. But in a similar way, you can apply them to $4 trillion companies now that exist, like NVIDIA, which happens to be actually in the Geospatial Index that I have assembled because of Earth 2 and even some in-vehicle navigation systems that they are participating in. So, yeah. Okay, so we've got the concept of part ownership of a business and exchanging those stakes in a business via a stock exchange. So something else that you can do is actually assemble groups of businesses. So you might want to have all the businesses in the world. And there's a company, a famous indexing company, we'll just say a financial product company called Vanguard. I think founded in the 1970s by Jack Bogle. You should really check out the Forum Bogleheads, which was the initiator of this concept of creating financial products based around indexes. And the whole point of them was to minimize fees. And this is something critical to know about, that, there are so many, the whole of Wall Street really, with all its glitz and glamour, in the end is a set of mechanisms to charge fees for people who are perhaps not paying attention to how high they are. And if they were, they would look at Vanguard and buying an index-based product. So this thing of an index, what am I talking about? So say I talked about the world, and literally you can, I think it's VTI or whatever the ticker is, you can buy a financial product which is based on an index of all stocks in the world. Similarly, you can buy one for the whole US economy. You can buy one for the whole UK economy, the whole Australian economy. It's very basic. For what can I say? So there's position sizing. You can buy 100 shares of the local pizza shop. If there's a shoe shop down the road and you don't like them as much as the pizza shop, maybe you only include in the index, 50 shares of that one. But the most basic approach is just to buy the same amount in each of the companies for your index. That's called an equal weighted index. So that's the approach that I've taken for the Geospatial Index. And because I'm from Australia and I, still my own personal portfolio is based on Australian dollars. So how I've chosen to do it is for every company from Aerometrics, a South Australian aerial imagery company, to Autodesk, something like a 40-year-old CAD company, I have bought 100 Australian dollars of shares in those companies. And then there is nothing more that I do. I just put them in the index and let them be. I don't care if they're the most terrible company that has never made any money ever since they were listed. The fact that they're geospatial, they get a chance and they go in the index. If they go bankrupt, well, then they will fall out. If they are a conglomerate, like, I don't know, Google, and because of all the antitrust things that are happening at the moment, for example, maybe Google Maps will have to be spun out of Google. And if, as a result of that, the original company no longer has any geospatial products, then the rules for my index say that then on that date, Google will be removed from the index and the index will buy shares in the new company that was spun out that's still geospatial. So it's the most basic rules possible, just to have as little intervention from me personally in being a fair mirror, a true mirror of what is happening in our industry via the stock.
Yeah. That makes sense. So, and sum it up in the way I think about it, these are, first of all, public companies that have agreed to sell some sort of ownership, as you said, the pizza shop did that or something like that. These are not private companies who are owned by somebody or some group. We don't know. Maybe we do, maybe we don't, but they don't have that option. And within the index, these are companies that you have decided have some sort of focus on geospatial. right? I think one question in there is, okay, looking at a company like Google. Google does lots of stuff. Some of that is, of course, Google Maps. They have, the consumer-based product. They have the enterprise product. They have their Google Cloud products. They have Google Earth Engine. So they are certainly in geospatial, but then they have many other things that they do. How do you look at if there's like, okay, they have to have 10% geospatial, or is it just that how do you kind of decide what includes someone in or out of the index?
Yep, this is a really important question. And actually, this is the second time I have gone on a podcast about this. The first time was with GeoMob, and it was Ed Freifogel. He runs OpenCage, that asked a similar question, and it's a fair question. The thing is, there's upwards of, I think, 34 companies now in the Geospatial Index. I am but one man without the $20,000 a year to pay for a Bloomberg terminal subscription.
Right.
So plus, for most of the time that I've been doing this, I had a full-time job. So yes, if we had an army of analysts, and another wonderful outcome of this, through raising the profile of this effort, I'd love to have, maybe I could start a Slack group or something like that. And we can actually be, a globally distributed army of analysts that I think this challenge deserves. Anyway, because I've, only have, I don't know, maybe 8 hours a week max to spend on it, I didn't have the time to trawl through all the 10Ks, the annual reports for US companies, and all of the other annual reports around the world in all the different languages, to really read through, and where I'm lucky enough to find, a clear declaration from the CFO of this company, who happened to think, maybe someone's going to care, about how much revenue specifically comes from our geospatial products. Let's put it in a nice table for them. Usually the segmentation is going to be by geography or, some other major lines of business. So this is to say that, unfortunately, I haven't been able to answer that question. So the approach that I've taken is, regardless of, if it's an $8 trillion company, which is, I don't know, they sell rice, if they nevertheless have the geospatial industry's most badass geographic information system about predicting rice yield, and it is absolutely fundamental to the geospatial industry and is very significant for us, then it goes in the index. So that's the rule for me. But I wish, I had all these other resources and tools to make better judgment there. So in response to this challenge from Ed Freifogel, what I decided to do was divide the index into adjacent companies like Oracle. And nobody can deny the impact on our industry since 1984, of when Oracle Spatial was released, 2 years before they went public in 1986. They have to be in there somehow. But what I put them in is the adjacent geospatial subindex, and the majority of the companies are in that. And then there's 111 pure play geospatial companies. So I mentioned Aerometrics before. They're in there. They're a terrible company, but nevertheless, they get a shot. And also, whilst I'm on my high horse about all of that, and aerial imagery companies, another one, Nearmap, an Australian hero of our industry that compounded at something ridiculous like 50% per annum, was taken private and stolen from us, public market investors, by Tomo Bravo, I think. We had Chris Sams on my podcast about that. So this is another way that we lose some of the best companies, actually, is the private equity firms often, are hunting around. They stole Maxar from us as well.
Well, I guess one big question is, how has the geospatial index kind of performed compared to other indices, the rest of the market, things like that? Because I think we all want to know, and people who work in this space, how is this space performing? And on top of that, how this is, let me put it this way. We all work here. We all know something about the technology and the stuff that we're using, probably more than many other companies. Like, I don't know how, some other things are done in different spaces, but we might have a stake in those things. course, this is something you understand a little bit more about, and you can have some sort of understanding of that. But if we put them head to head, what does that look like? Of course, I'm sure all these companies are subject to market trends and things happening around the world and all this different stuff. But how's Geospatial doing?
Yep. This is a great question. The first response is that there is some volatility. So depending on, the month or the year that I check in and tell that to you, sometimes the market is winning. So therefore, this whole effort since August 2022 is totally moot and you should just ignore it. But sometimes, again, depending on volatility, the market is losing. And by the market, so there are many indices to track the overall performance of the market. Perhaps the most popular one is so-called S&P 500. There's an old, venerable, respected financial services firm called S&P Global or Standard & Poor Global. They're actually listed on the stock exchange themselves, and they actually have many interesting geospatial services. So I've put them in the index. So their S&P 500 fund is, it's actually an actively managed fund. There's a committee that made interesting decisions, such as to keep Tesla out of the index, despite it being a very large company for a long time, because of doubts that committee had about the quality of its management, and really if the earnings were credible. So I just wanted to flag that briefly, because a lot of people think that it is just a bulk standard index without any judgment made. Anyway, so the S&P 500 is the market, and this brings up a whole very interesting area of study. But by some measures, through some whole string of academic studies, one might say that there is 150 years of history of an index in some way of the US market. And the version that I pay attention to over that 150-year stretch is the one that captures capital growth, so the increase in value of the companies, but also importantly, and you must not forget this, the dividends that come from the money that's distributed to owners of the company after paying for the maintenance of the company. So and if you adjust that for inflation, this is another key thing. The 150-year compounding rate of, as I said, capital growth, dividends, and adjusted for inflation of the US market is something of the order of 6.98%. So why am I taking this slightly tortuous path to answering your question? It's because you can just look at, for example, the past 10 years, and you will come to the conclusion that we've had an absolutely rampaging market where the compounding rate per year has been something like 15%. But you will be sorely disappointed if you expect that that's going to persist forever into the future. If you look at a chart of something like the past 100 years, there are literally multi-decade or decade and a half stretches where the whole market does nothing, and you would get no growth whatsoever in the capital. There'll be no capital growth. It would just be dividends that you're receiving. Why? I just to show that. Whilst I am a little bit naive, I'm not a CFA, I have taken the extra step of looking at this concept of so-called base rates. So the base rates is what is this very long-term benchmark. So perhaps it would help if I shared a slide. You've got that. Step 2, there's a whole lot of material there about why this is important, which I'd like to get to at some point. Okay, so here we are. And this is current as of a few days ago. So maybe I think it was Monday this week. All right. So as I said, the S&P 500 is down the bottom there. And for the past decade, it has increased by 13.755% per annum. So this is essentially beyond double what the 150-year returns appear to be for the market. And in this particular snapshot, considering the volatility conditions at that particular point, the Geospatial Index is significantly outperforming it by 2% per annum. So then I was telling you about dividing it up into adjacent and pure play companies. So actually, the adjacent ones, including importantly the big tech stocks or the Magnificent Seven, is another term you'll hear. The compounding rate of that is actually 19% per annum, and the pure play stocks have actually been, really bad, honestly, 7%. And then perhaps some of you have heard of the GeoAwesome blog, run by Mutakumar and another colleague of his. So they have this GeoAwesome top 100 list maintained by I think it's a set of experts across the world in the industry. I was
Right.
actually on the selection panel, and it just so happens that at the time they took the snapshot, the compounding rate for that was 21% per annum. So yeah, and this is on to base rates. Who cares really? I'm sorry, about the past 10 years of compounding. You need to express that actually as a multiple of the long-term rate. And at that time, it was 1.74. So what that means is you need to divide this 15.82 by 1.74 to get to and the long-term true compounding rate for our industry, which at the time I think was 7.99.
Yeah. And I think that, it's an important question to ask because there's, I think if you just kind of take a whole picture of our industry, right? There's certainly a lot of growth in many different areas from technology and things like that. There's also kind of a big question out there, I think, and twofold. One, I'll talk about the market, and then two, I think about what it means for just the everyday individual kind of working in GIS or geospatial. One is, I think, kind of how we continue to grow the space. If you're sitting there, there's lots of reports saying, the space is worth X many billions of dollars. You see these every couple of months, and the geospatial industry is expected to grow by this much. There's these consultancies that put these numbers out there, and then you can go Google them and Geospatial Market Outlook, and they talk about all those different things. At the same time, I feel like there's sometimes a challenge of like, well, we're still kind of in our bubble, right? A lot of our technology is still used, kind of people talking, companies selling to the same companies in geospatial, kind of working that. And we're still trying to get this moment of how do we break geospatial, geography, all these different things into the rest of the big world, the market, the companies that you want to use this data. So I think what's interesting that what you're reflecting there and the way I'm kind of interpreting that is like, that things are going up, right? If you look at, the big kind of, indexes, some of the top companies in the world, all things are growing up. What I think is highly interesting there is that there is a segment of geospatial companies from that kind of, geospatial 100 that are doing very well, kind of outperforming, even just by, a few percentage points. And there's some that are struggling, right? Which I think is reflective of any market, right? There's always going to be some that are doing well and some that aren't. But overall, there's an upward trend, which is good to see. And I think something like that. So what's your take on a very high level? If you look at kind of the big picture here, where we're going and what the challenges are and who's succeeding and what are they doing?
Yeah. So I'm going to say I wish I could answer that question, Matt. And I can totally sympathize with that being the first reflex that people would have. They want some sort of a contrast with, all of these breathy, hypey, Wolfpack. I think that literally that was the name of one of the companies that produced, one of these compound annual growth estimates for our industry. So, what is my opinion accompanying all of these other research efforts? And I will say to you that I don't have one. The reason is that that's actually not the purpose of this. I would love it to be another outcome from this discussion. There are many things that could happen in the future, but this is where I need to come back to really what the purpose of this exercise was. And in making this point, let me share another slide. Let's go back. So this is actually, the second market that I've prepared this set of slides for. The first market was the UK. And there was, interestingly, a similar phenomenon in these two jurisdictions or economies. So in the UK, there was a chart similar to the one you're seeing here, but it actually started in 2008 during the financial crisis, where wages and inflation were tightly coupled. And then after the financial crisis, basically wages flatlined. And if they don't keep up with inflation, well, then a cost of living remains or increases, significantly, or at least your wages don't allow you to keep up with the cost of living. So there's a similar division here, but in the US, from this research by the Niskanen Center, starting around the 1980s, there has been a continuation of the trend in increasing worker productivity, but compensation for that productivity has not kept up since the 1980s. And what this research center is saying is that productivity has grown by, as it says here, something like 97%, compensation only 19%. So if you convert that into, or consider that or express it in terms of the median income in this economy of 60,000, multiplying that by 1.78, which is the difference between these two percentages. In fact, if compensation had kept up with productivity, then the median wage of Americans today would be basically 107,000 US dollars, but it is 60,000. So in my sort of searching around to make this relevant to the US audience, I came across a few studies from, the likes of Brookings Institution. Literally the first sentence about, in this article from Brookings Institution about why wages aren't growing in America, the first sentence was, as it says there, the majority of Americans share in economic growth through the wages they receive for their labor rather than through investment income. And the rest of this, multi-page, very diligently researched and, written article was then about wages. But really, all you need was to read the first sentence there as your marching orders. It sounds provocative, especially in the US economy where everything is about being productive and increasing your productivity. And you, Matt, are a shining light on the hill in our industry, at least in terms of supporting that increase in productivity through the Spatial Lab and trying to turn as many people into geospatial data engineers as possible. This is fantastic. And there are credible increases in income as a result of that. But the funny thing is, since the 90s, efforts to do that haven't reliably resulted in a fair outcome in terms of compensation. And what literally in one sentence, the Brookings Institution is saying to solve that is that you must be a multifaceted participant in the economy. You must not only be extracting the income, economic value through your income, you must be translating your knowledge as an insider for an industry and gaining an edge over other investment analysts through taking ownership positions in the companies that employ us. That is how you through this multimodal approach of economic participation, through being not only a worker but also an owner, that you will close the gap between that has been emerging since the 1980s and bring things back in your favor, or at least keep up with everyone else in the economy, especially investors.
Yeah. Well, there's been a big shift in there's lots of great kind of research on this topic, and the shift of moving from just everything being, income based to now you're having, like you said, a multimodal approach. It's certainly interesting. I think I've talked about, just even in geospatial, the income gap compared to, other, very tangential industries. GIS analyst, data analyst, things like that. There's just continues to be an income gap, and there's lots of reasons why that is. But I think what you're kind of arguing and advocating for is that one, be a participant in that form of the economy. Many times you may be, and it may not seem like you are, but anything, if you have any retirement or any of these other modes of, kind of part of the way you participate, that's certainly one component of that. But what's more interesting is I think, like you said, going back to kind of why you create this, is if you are specifically working in the space, you have a unique knowledge and unique view of taking a look at these types of companies operating in the space. You understand more than the average Joe on the street. I don't know more than the average Joe about the street about many things, and other people in other industries might have more knowledge about it.
I have something to say here, Matt, and it takes us full circle here because I started talking about doing this value investing course and learning this framework. So I can actually show you something or an example of putting this framework to work on my Substack, geospatial.fm, which is also the URL for the podcast. So if I go down here to a diagram from the textbook, and maybe there we go. So this is the framework that I've learned for valuation-based investing from his book, Good Stocks Cheap. On the left, the first thing is, do I understand it? I need to understand it on 6 dimensions: products, customers, industry, legal form, geography, and status. So status is things like, are they the dominant firm in the industry? Has there been recent legal, court cases, negative press coverage, positive press coverage, things like that. So the framework basically says you can't go any further, let alone, in terms of analyzing the company, let alone taking an ownership position, unless you understand it. So picking up on your point there, Matt, about us having a unique understanding, yes, we do. We do have a unique understanding of the geospatial stocks in the market. I sort of realized, if I'm to be true and faithful to this framework that I've learned, well, then, why not leverage this, 15 years of experience that I have in, my particular career and put that to work in this multimodal participation in the economy, generating an income. And I just wanted to complete this point about you were saying there's a difference in income between, depending on the career track you have. If you have the typical GIS technician to analyst to eventually, if you're on the non-leadership track to spending, the last, decade at least of your career being a principal consultant, you can contrast that with the career track. And I've tried to, the leadership track. So I have put together a little study of that on a few slides. So here you can see the executive track or the leadership track, in the cells highlighted yellow on the left here. The lifetime income is something like, in this economy, $9 million US. Although I have had a chat, with actually the CFO of a publicly traded company since preparing this. And he said that, the salary of $500,000 for the CEO is actually quite low, especially in this economy. You should more like put, $1 million per year. So perhaps it's fairer to say it's more towards 20 million for the executive track in this economy. But the lifetime income for a reasonable progression of salary from 50 grand, as a GIS technician at the start to 95,000, at the end as a principal GIS analyst is something like $3.5 million US. And if you were to listen to what you're saying and become a geospatial data engineer, it's something of the order of $9.5 million US. So all of this, as I said at the beginning, this is about the little guy. It's about, the person who is a diligent worker, but perhaps doesn't have, the panache or the leadership potential to go on to the executive track. So what can we do really here to solve for the income of over a lifetime of effort, 43 years working after a 4-year degree of 3.6 odd $million. So I've taken the sort of provocative approach of sort of asking, what if an investment banker came into our industry and suddenly, became aware of what this lifetime income is through working in the industry? Mm-hmm. Let me get to the slide. So what is it that this investment banker would have to invest over a 47-year period to match the lifetime income of this regular non-leadership track GIS analyst? 3.5 million is what I've gone for up in the top corner. So it was actually, after adjusting for inflation and base rates, 7.32% annum that this group of 380 odd stocks delivers if you have an equal weighted index and just buy and hold for 47 years. Of course, this is all theoretical. This is, in some respects, a stab in the dark, but informed by, I hope you can see a little bit of research. So what the investment banker would have to invest to match this 3.5 million outcome is $126,713, and just hold those stocks, watching Netflix, feed up on the couch for 47 years. So I just wanted to finally get to that point in this analysis for everyone to really bring home the point that the people with capital and money who don't actually work, if they can literally just duplicate your lifetime income with this, just north of $100,000. And I've, done similar, analyses for every sub-index or vertical in our industry. And, you've got the GeoAwesome top 100 after base rates and inflation that 21% becomes 10.3%. So the investment analyst or the investment banker would need, just shy of 35,000 to replace your lifetime effort. And I've also done it for closing the productivity gap. So, if you're having that 1.78 multiplier to close the gap in compensation versus productivity, you'll need to increase your lifetime income as that analyst by $2.73 million. So that's what this final column is here. And if you just want to do that, then you need to put in just shy of $100,000 into the market. Yeah. And then there's the last sort of effort here. So maybe you don't have that, $100,000 as personally, as this worker, hence you are, actually in the job market trying to earn an income. So what I've put together here is a stab at how to use your own income to do that duplication of your earnings using just the market, right? The market that employs us, the Geospatial Index. So you can see here, the first 3 years, I'm proposing that you spend the first decade of your career investing to achieve this duplication or to close the productivity to pay gap. So this is to duplicate earnings. So you'll need to invest for the first 3 years, 85% of your income. And then for the next 7 years, 16%. And overall, that requires you to invest $207,500. Bearing in mind that is 32% more, or $80,000, $81,000 more than the investment banker, because you're doing this over a 10-year period, and the investment banker has that 10 years of compounding in their favor. Just to close it out, to close the productivity to pay gap, to gain this extra $2.73 million, you would have to invest $162,000, so 25% of your salary for the first 3 years. 61% for the first 3 years and 14% thereafter. So yeah, that's coming full circle for me, reflecting the purpose of this exercise and addressing this provocative concept that, those in this country, it's Manhattan bankers. Yeah. In London, it's the Canary Wharf bankers or the City of London bankers, addressing this somewhat disturbing and provocative idea that they can just with, just north of 100,000, duplicate your entire lifetime of effort, and how to get there yourself by investing in the companies that employ us. Given that it's around about $150,000 that you need. So actually, if your parents invested $40,000 and let it compound for 18 years, so when you were born and invested $40,000 and left it for 18 years, they will be able to give you that $150,000 when you turn 18, and then you can do what the investment banker would do. Yeah, there's some interesting mathematics you can do, but I think it's interesting to think about. And I think these numbers and concepts are arresting enough for us to think seriously about, again, this multimodal approach to participation in our economy. And it really is easy to start to do it. You just open up an Interactive Brokers account and take, importantly, a long-term, lifelong, multi-generational, preferably, approach to participation in these markets, in the market.
Yeah, I think what you've hit on is that, that there's lots of different information about taking the long view, right? If you look at this in terms of hours or days or snapshots or things like that, there's lots of things that can change very quickly, right? But if you look at this as, kind of a long-term view and something you can take in baby steps and things like that, there's certainly significant benefit, and certainly kind of a way to be a participant in this space. It's tricky because I think a lot of the things that I'm focusing on are, that immediate upskilling, the ability to kind of, work in different spaces, kind of understand what's happening from a technology perspective and all those different things. But that all plays out in terms of, what are, the goals of either of those things. If you're upskilling, you probably want to move into a different job, be it for, quality of life or, maybe income. And that's one big thing. On the flip side, if we're talking about companies, they're selling things, and their goal is, of course, to make money, unless they're completely a nonprofit, which is a different model. But at the end of this, I think this discussion, this exercise that you've gone through very diligently using these well thought out frameworks, add another layer to that. And I think that's kind of what I came to after our first discussion, after, hearing this today. So there's another piece here where there's these public markets, there's another layer to that, which is simply taking the benefit of those efforts, either your own personally, grow your own personal growth, or being, a participant in, the growth of these companies that are publicly traded. And that can be another layer that you can add into this mix. It's not I don't think there's ever a one, kind of all in on any of these things. Right? It's you can't just say it's all, but I think as you're exploring your own growth and goals and things like that, this is just another layer in that. And it can feel really strange because it feels much more less out of your control in some ways. It feels like you're dependent on all these other things happening and going a certain way and stuff like that. But at the same time, there has been some level of consistency. And we know that. And this is, for better or worse, this is the way that our economy and the way we do things in the world has shifted. And it's just another layer to that. And I think that's kind of the thing I took away from that is, okay, this gives you an easier way to kind of approach this. You have knowledge about these spaces. You understand the things that are going into it. You understand what works and what doesn't. And you have a potential way to make that more approachable for this participation in public markets. And that's kind of my view of all of this, is that it's another piece of how you want to grow. And I don't know your take on it, but I think that's kind of the way I've been looking at this, going through this discussion. It can feel daunting. Like, it feels even to me daunting because it's not the stuff I deal with day to day. I talk about I'm writing code and stuff like that. Now all of a sudden I'm in spreadsheets and numbers, but it's just another piece of the puzzle.
I mean, there's something in the back of people's minds. I know I was cynical about investing in the markets for so long, right? It's like my eyes have been opened really, but only since 2019. And once you learn a framework, it's actually like you can go to the 10K or the annual report for Starbucks, right? It's all right there. Do some basic mathematics from the numbers that are in those annual reports, and you can see, how successful that business really is in terms of its return on capital employed, the multiple of the number of years of income to pay for the business. It's just like the level of empowerment that you get becoming a geospatial data engineer, where it's been a revelation to me, Matt, really, the Spatial Lab and the support that you offer, in terms of the power that I'm gaining. But what I'm working on right now, because of what you're doing, is this effort to look for all the CAM mystics around the US. But that is a nation scale analysis using all of the flood polygons and all of the Overture Maps Foundation building footprints. This is a hugely intimidating challenge. But through the upskilling and the productivity gains that what you're doing offer to me and others, it's like having my eyes opened again, in terms of reaching the next level. In a similar way, being able to look through the books of a business as they are expressed in an annual report is the same kind of thing. And someone who is grabbing life by the horns, right, who really wants to get the most out of things, you have to do both things. And I use the word have to. I want to do both things because it's really exciting. It's really interesting. Like, through the analysis that I've done, like, you can go to all sorts of depths. You can do a contribution analysis. You can see how much of the overall index gains a given company makes. And it's actually Oracle that's the one that's responsible really for 60% of the overall gains. What does that deliver to us as a message, as analysts, right? As the people who use the tooling? Well, it says, spatial databases are basically everything for our industry. And that's a funny message, isn't it? Because I, as taking the investment banker's role, am telling you guys, that it looks like databases and spatial databases really matter. Well, if we go over to your side, where you're taking the productivity approach to boosting economic gains for our industry, Matt, well, you would say the same thing. It's spatial databases, it's spatial SQL that is the critical basic skill that will generate for you the greatest financial returns through a salary. So isn't that a really interesting outcome?
Yeah. And I think that's exactly the way to look at it is, finding those trends. I mean, this is something I've found through a completely different path, right? Through learning, seeing what is adding productivity in terms of the ability to, do more with more data, scale, find more interesting trends, stuff like that. That fundamental data layer is really, I believe, where there is a lot to be discovered, right? And there's a lot of that same trend is that's reflected in all these things happening from the market side, which is very interesting. And I think what you hit on there is like all of this, to sum up, is around, for me, and why, honestly, why I started, I'm sure this is why you started your exercise and why I kind of started putting these things together, is helping people grow. I think there's a lot, if you look at the space, GIS, everything like that, it is incredibly interesting. We all got into it because of probably a passion about understanding the data, the ability to draw insights, make our world better, anything like that. At the same time, there's a lot of concern about how do we grow, right? I see it every day when people asking about, on Reddit, there's, just what's the growth trajectory for our industry? What's the growth for this role? Is it worth getting into? Should I pivot out of it? You can just go read, the GIS on Reddit. And I think what I see in that is that, the more we can expose people different ways to grow and ultimately get to where they want to in their lives, the better. And this is another mode to do that.
Yeah, and maybe, I can sum up too. So the thrust of the, again, diligent, very useful, very insightful reporting and analytical work from the Pew Center and the Brookings Institution is that over time, so over the decades, over the centuries, throughout history, there's a pendulum. And sometimes the pendulum swings in favor of labor, and the economic returns from just being a laborer are decent. Sometimes, due to a combination of policy, ideology, whatever, whoever's winning, whoever has the power, sometimes the pendulum swings in favor of the owners and capital. So what's the intelligent thing to do here? Well, it's to be a participant in both, so that regardless of where the pendulum has swung, you are still nevertheless riding the overall economic wave that the industry you've chosen to participate in offers you. And if I can, this is about the numbers in the spreadsheet. So if I'm summing up, permit me one last illustration here. So if we go down to the end of this, is to close the productivity to pay gap. So I'll focus on that one because it is this provocative idea that it does not serve you well. I'm sorry. To solely focus on increasing your productivity. You must attend to this phenomenon of sometimes workers not being fully compensated and sometimes the business owners being ones who are the ones that generate most of the returns. So towards the end here, after year number 42, the compounding returns per year actually become more than the salary. Okay, so what are all these cells? So this is the year, the income you're getting the first 4 years you're studying, so you don't get any. Balance of the compounding income after cost of living. So I've also contrasted it with that and the notes. So here, after the first year, you're living with your parents because you're saving most of your money. You can't support a family for the rest of the first 10 years because you're underwater. And then, by year 15 or year 11 of actually earning an income, you're scraping by. But then what happens is, suddenly you get in the clear and you're, significantly ahead in terms of living costs. You're 12,720 ahead in terms of the income that you're earning. But what's also happening per year is you're getting this much in income from your investments, right? In this particular year, 56,000. And then what happens down here is that, by year 38, you're earning 95,000, but your income from investing suddenly becomes more than what you're earning. So I just wanted to flag this. I've tried in many different ways to bring an indelible, hopefully sometimes a shocking, overall a memorable impression of the benefits of this multimodal approach. And if an outcome is that your income from investing matches your income from working, I hope that is memorable to you. And look, what did I have to do? Did I apply any fancy financial models? Am I a hedge fund investor? No. All I did was spend, months on end, I confess, multiple nights up till 5 a.m., just collecting every single last geospatial publicly traded company from Vietnam to Thailand to Finland to there is some South African companies in there, to Australia, to the US. And I just dumped them all in an equal weighted index. No fancy Goldman Sachs style stuff going on here. And, funnily enough, what could be the next step after that is to create what's called an exchange traded fund, where all of this goes into something that is tradable under one instrument on the stock market. Yep. Anyway, regardless of whatever way you take, I'm saying to you that under reasonable assumptions, there is a significant stretch of your career where the companies that employ us can actually result in a income from investment that matches and then exceeds what you get as a worker.
Yeah. And it's funny as you say, like these endless nights up till 5 a.m. and stuff like that, because I feel like I did the same thing and I was trying to debug do something with SQL or figure this thing out, right? Why I think this was a great conversation was because, you're and to bring it all to a head, I want to make sure people know where to find about you. You're writing the things you're talking about, all like that. You've spent the time putting these things together so people can access them a lot easier and kind of skip the work, right? I mean, I've tried to do that with, by sharing content that I, have put together, learning, put into formats to make all those things that were tough just easier for everyone else and help you jump ahead from that perspective. So with that said, where do people find out about you? How do they keep up with things you're thinking about and learning, and where I mean, you mentioned one already with Geospatial FM, but
yeah, so there's the podcast Geospatial FM, and this reflects that another form of capital, we're talking about financial capital, accumulating intellectual capital to make yourself a more productive worker. Another form of capital is social capital, and you get that through building networks. Hopefully a network that connects with, the center of power in your industry. So the large companies, CEOs of those. So I have been making a deliberate effort to gain that social capital through running the Geospatial Index podcast. And I've recently changed it over to Geospatial FM, reflecting that it's to do with broadcasting, but also reflecting the recent trend, you've been talking about trends, of foundation models in our industry. So geospatial.fm is the Substack. You can search for it on YouTube and Spotify and all the other podcatchers for this series of conversations I've been having with amazing leaders, inspiring leaders and entrepreneurs in our industry. The latest one really that stands out is Juliet Murphy, founder, CEO of FloodMap, which is an amazing forecasting system with a strong geospatial flavor to do with floods. That's a way that people can keep track of my work. What I did for a while was weekend updates, which gave you, for example, these contribution analyses, and that's how this concept of the significance of Oracle bubbled up. But there's just so much more that can be done. And I think there's a huge potential here for a proper financial analysis service. And also, I am going to raise this cliched concept of actually a training course. And I know that there are so many. Is there a single YouTube channel in finance without a training course attached? I don't think there is. I've been, somehow strangely not following that trend. But I actually think that in terms of an all-encompassing effort based on the long-term view and an informed view of trends in the economy and how economies change over time, in fact, there should be a training course that informs people how to have a productive encounter with the markets. And also, there's potential for a paid service, I think. And ultimately, an ETF, actually. An indication of my accumulation of social capital here is that next week I have a brainstorming session actually about an ETF with AlphaGeo, which is run by Parag Khanna, and it came out of a podcast episode with Michael Ferrari, their investment officer. And they have a geospatial analysis based model portfolio or fund. So this is the progress I've been making. And, this is the potential, perhaps. Something else, you've mentioned trends so many times, Matt. So that's another thing, because I've been doing the bulk standard thing of just accumulating, regardless of the quality, all of the companies. There's a pointer to a possible direction here where I've categorized the market into 27 verticals. The latest one that I've added with a single component is net app. data infrastructure is this new vertical. And you saw when I shared my screen that for the autonomous systems vertical, you'd only have to invest $111 and let it compound 47 years. You'd have the lifetime income. So, but there's a risk there that maybe the trend won't continue. Yes, that is the next area of study to drill into. And if we accumulate a group of us who are motivated, and necessarily it should be global, perhaps we can have some credible intelligence about what are the durable trends and where money could be put, rather than just having an equal weighted fund that biases towards certain trends. So I would love to have a group somehow that is part of a decision-making body behind an ETF that generates more than that 7.32% adjusted for base rates and inflation that the Geospatial Index is.
Makes sense. Well, I think you've been doing this for a long time, putting out a lot of amazing stuff. So first of all, thank you and congrats. I think this was really cool to kind of show the multiple ways and various ways to kind of grow and be successful in geospatial. Multiple ways to look at this. I think it's a good lens. And I think, if there was a geospatial ETF, I think that would be a really cool way to really bring this to a really nice kind of way for people to easily access that and just, be able to participate in that. So that's really cool. So yeah, Will, thank you for taking the time. I think this is a lot of education for me and something I don't do a lot. So I think that's what I enjoy about doing this, is learning a lot of different things more than my regular day to day. So thank you for that. I appreciate it. And I'll drop everything in the show notes so people can get in touch. But yeah, thanks, man.
Awesome. I just want this not to be the end. It has to be the start.
Yeah, for sure. Totally agree. Well, yeah, appreciate it. We'll be talking soon. And yeah, thanks for hopping on the show.
Awesome, Matt. Appreciate it.